Hi, I'm back. This is part two of episode two of 5 o'clock macro. And we're going to resume our conversation about gross domestic product. In the first part, we laid out the formula of GDP equals to C plus I plus G plus X minus M. And now we're going to go through the different elements of GDP. The first one being consumption. Consumption is the largest item in the GDP formula. And within consumption, there are three broad categories. The first is durable goods, which are things that last a long time. So your automobile, refrigerator, home appliances, those are durable goods that go into this category. Um, and then you have non durable goods, which would be things like food from supermarkets, shoes and clothes, marijuana now in places where it's legal. Those are non durable goods, meaning that they're bought for the purpose of immediate or almost immediate consumption. The food thing is complicated because this category includes food that you buy in order for you to transform it yourself, meaning you're going to cook it or you're going to consume the beverage, as opposed to uh, what you do at a restaurant. Restaurant meals, takeouts, etc., are actually services, which is the next biggest category within consumption. So services also include things like your cellular phone bill or Comcast bill. And services also includes some housing costs, which are a significant component here. But the housing costs under consumption relate to rents and the imputed rent of homeowners. So I own a house, and I also live in the house. The house has rental value for me, therefore, that uh, gets included within the calculation of GDP. The next category within the formula is investment, I. And within this, there are four broad categories. The first is residential construction. So this covers the new construction of residential housing, whether it be single family homes or apartment buildings or what have you. This is included in investment, but only the new housing. Similarly, there's non-residential construction is included. So when people build an office building, they build a shopping mall or a plaza, that would be non-residential construction that would be included. It could also be when a university or a hospital builds a facility on their campuses. That's also included in non-residential construction. And then the third area is what we refer to as equipment and intellectual property investment. Equipment, or would be the furniture, computers, etc., production equipment that would be included in the non-residential construction when it occurs, or over time as folks replenish their production stock by buying new machine tools or what have you. When that stuff's new and it's purchased, it gets included in investment within the GDP formula. The items known as intellectual property investment, this is relatively new. And this happens every once in a while as the GDP formula is revised and new things are added. And the reason being that firms are spending significant sums on research and development, and they were creating assets that had some kind of useful life out into the future. And so they were, it was a hole that was missing from the calculation of economic activity. And as such, it was added, and they went back and estimated the value for previous years, so we can keep it systemically consistent basically over time. The final category is what's known as change in private inventories. And this is firms that are manufacturing something. Let's say I'm a manufacturer of motor cars and I start off the year with $500 million worth of inventory. And over the course of the year, I sell some, I build some, and at the end of the year, my inventory value is $600 million. Well, even though I built a whole bunch of stuff more than that, I sold some of it. So what I'm calculating is the net change. So 600 million minus 500 million is 100 million. So I would be adding $100 million to GDP through the change in private inventories. Now, it also works the other way around. So if I drew down inventory, which happens frequently, I started off the year with $100 million and I'm down to $50 million. I had eaten into inventories by $50 million. So it's a deduction of $50 million from inventory that would be calculated into this category. The next item is G for government spending and social investment. It's broken out by, in the US, federal government spending, two categories, defense spending, and that is a broad category that includes folks from, or money that's spent on our armed services and weapon systems, sort of everything in between. And non-defense federal government spending. So the federal government spends money to employ a whole bunch of people that work in different agencies. The expenditures on those folks and the contractors they hire all would be included in that non-defense subcategory. The kind of thing that's not included under federal government expenditures is checks the federal government writes to state and local government. So, for instance, the federal government spends a significant amount of money each year on Medicaid by sending money to the states to subsidize their expenditures on the Medicaid program. That money doesn't show up in the federal government bucket, but rather the state and local government bucket when they are purchasing those particular types of services. The other thing that doesn't show up under the federal government are Social Security checks and other forms of what we refer to as transfer payments. So when government writes a check to an individual in a form of social insurance, that's not included in this category of G for GDP, but rather that income accrues to someone who then will either spend it on consumption or save money. And when they spend it on consumption, that's included in GDP. Then state and local government spends a significant amount of money that's calculated in GDP. So the consumption expenditures would be things like school teachers and police officers, firefighters, folks that work in libraries, the senior centers, social workers, etc. Those folks are, their pay is included under that consumption expenditure. And then there's a gross investment category for state and local government, because state and local government also builds infrastructure. They build schools, they build town halls, they build roads, water systems, what have you. And all of that money gets accounted for in GDP under the government heading. And then the final category is what we refer to as net exports. The international sector is a very important part of overall economic activity, and every country participates in it either by exporting or importing both goods and services. So in the United States, we export goods, so we manufacture cars, we manufacture pharmaceuticals, we ship those overseas. We also provide services to folks overseas. So we do banking services, financial management services, and my personal favorite, when we have students from abroad who come here to the United States and they're purchasing tuition and fees at colleges and universities. They're acting as a receiver of an export from the United States. We also import. We import many of the same things we export. So we import cars, we import pharmaceuticals, we import food, we export food. It's different categories of stuff, and in both exports and imports. There are some sectors, as we all know, that are heavily dominated by imports, like clothing, shoes, consumer electronics, those kinds of things we import, as well as we import services as well. And for the last generation or so, the U.S. has run a persistent trade deficit, which means that our net exports number in GDP is negative because we import more than we export. It's a big negative number for goods. We import a lot more goods than we export. For services, we actually run a surplus, meaning that we export more services than we import, but that number isn't nearly enough to make up for the difference in goods. So we have a minus there of around 3% of GDP each year. Now, there are some important rules to keep in mind with respect to GDP. We only count final sales to consumers or firms of goods and services. So we do not include used cars or secondhand goods at all. That only gets included in the first time those things are sold when they're new. We only count transactions that are denominated in money. So the significant value we generate through work in the home, which doesn't have an explicit financial value, is not counted. So, for instance, if your parents provide childcare while you're at work and you pay them by allowing them to raid your refrigerator, that doesn't get included in GDP. But if you enrolled your child in a preschool program where you paid tuition, that would be a purchase of a service within GDP. Purely financial transactions are not counted. So our purchases of stocks and bonds don't count in GDP. So all of that financial activity that occurs on Wall Street, almost none of it is included in our calculation of GDP. And I mentioned before about the rules around federal government spending and the fact that transfer payments like Social Security checks or TANF or what have you aren't included in GDP, but it gets included when we expend the money. So this has been a good introduction to our discussion of GDP, and we will resume more in our segments tomorrow to talk about it in more detail and some of the other issues related to GDP. But I want to leave you going out with David Gray, Babylon.